In the 1980s, hundreds of American banks failed in a massive financial collapse. Let us look at what happened. The crisis was defined by widespread insolvency, which means institutions could no longer pay back their depositors or lenders. Over 1,000 institutions closed their doors, marking the biggest financial disaster since the Great Depression. Several factors combined, including soaring inflation and poor lending choices, which left these banks unable to cover their liabilities. Savings and loan associations were specialized lenders for home buyers, while commercial banks handled a wider variety of business and personal accounts. The total cost to resolve the mess reached $160 billion, with taxpayers covering the vast majority of that bill. This event led to much stricter oversight for all financial institutions to prevent these kinds of catastrophic failures from happening again. Understanding these historical events helps us see why banking regulation matters. Thanks for watching, and remember to keep learning.